All right, let's get started again. There were a couple slides at the end I didn't go through on M&A modeling. I'll just point these out to you now. If you do want to do the full merger model, we've got some assumptions toward the end of the slides. Very similar deal to what we spread here in class today. But we also have a step-by-step approach for the full M&A model as well. So basically slides 24 and on will give you a step-by-step walkthrough of how to put together that model. Basically one tab to the next will give you screenshots of what the completed worksheet should look like. So here obviously is a pro forma balance sheet after it's been done. Okay, we've got the full model, the model tab. We've got the assumptions, more assumptions, cash flow statement, debt schedule, etc., synergies model. Okay, then back on the first tab, analyzing the deal. What is the ultimate impact on earnings per share? All right, base case upside, 08, 09. All right, so you can go through that as well. All right, nice little helpful guide if you choose to do that, that full merger model. We're done in Excel at this point, so if you want to shut down your laptop, you can. You won't need it tomorrow necessarily. Basically, from here on out, we're going through PowerPoint. All right, and the rest of today, we're going to talk about the M&A sale process. So basically, what do bankers do after they've won engagements with clients to sell companies? All right, we probably all know there's a wide array of different options that are available when structuring a sale. We'll talk about some of those in a moment. But basically, an M&A banker is going to work with the client to do a number of things. First of all, analyze some of the exit strategies that could be employed. Who might buyers be for a particular offering? We'll talk more about these a little later today. We'll also talk about some of these tomorrow when we talk about pitching, how those get identified and presented to clients. Obviously, valuation is important in any transaction, so that's a major component of M&A. Timing of the sale, tax consequences. We don't get into a lot around taxes in this course, but taxes can be very important in any transaction, can make or break any particular deal, so that's something that M&A bankers and accountants spend a lot of time on. And then, what type of role, if any, might key management team members and employees have on a post-transaction basis? Sometimes that can be very important. That can be an important consideration in these deals. All right, so outright sale, a lot of times that's what's pursued in M&A. Company just sells 100% of itself, but is not, that's not always the best or the right option for a company. There are other different alternatives that can be employed. Retaining some equity in the business, maybe selling the company to employees, maybe divesting of certain divisions or certain assets of a company, maybe bringing in some working partners, maybe bringing in a joint venture partner, bring some additional equity into the company. There might be some other hybrids as well. There are a lot of different options here. All right, what we're going to talk mostly about today, though, is selling 100% of the business or maybe divesting of a division or something like that. What steps does an M&A banker take in that process? With any transaction, though, confidentiality is always a major issue. If you go to work for an investment bank, it's going to be drilled into your head. You have to keep things confidential. You'll sign all different types of agreements saying that. You can be held, I think, criminally liable in some cases for violation of insider trading laws. But a leak in a deal can have a major impact on that deal, can have a major impact on the client. All right, so if it gets out that a change in ownership is being considered, obviously there are a lot of folks in the marketplace who could capitalize on that, competitors probably being the most obvious. All right, and basically competitors taking that information, going out to different business partners, to vendors, to customers, creating a lot of upheaval in the marketplace. Because again, a change in ownership would cause a lot of those partners, vendors, customers to really question their relationships with the company, put a lot of their business dealings on hold until more of those issues regarding ownership are flushed out. Employees, obviously, if a leak gets out among employees, major consideration, major concern, right? Employees are concerned about their job. Basically going to really be questioning, standing around the water cooler talking about how a pending sale or a potential sale might impact them. All right, so that can be a major issue. And obviously with public companies, it's an even bigger issue if that gets out into the marketplace. Insider trading, all of those different things can affect stock prices, can affect whether a deal even happens, et cetera. Basically, if there are leaks, it usually reflects a poorly run process, can really have a major negative impact on a bank's credibility. So as an analyst, as an associate, if you're on a deal team at an investment bank, it will be drilled into your head. You can't talk about it to anyone for any reason at any time, just no exceptions. So what does the banker do once they get hired? Once they get hired, they're basically being brought in to run a fairly well-defined process. Right? There's really not a lot of secrets as to what goes on in M&A. It's a pretty standardized process these days. It's basically an execution role where the banker is doing a number of different things. And we're going to talk about each of these in detail the rest of today, but things like, as we discussed a moment ago, working with the management team to help define what exit strategies might be available to them, valuing the company. Obviously, like I said, valuation is always a major part. Possibly recasting some financial information. All right. Presentation, packaging, putting together a deal book, putting together materials that are going to go out in the marketplace, that are going to be sent out to potential buyers. Qualifying those buyers, figuring out, to Mohammed's question earlier, who would be a good strategic fit, who would be a good cultural fit. Do they have the capacity and the capability to close a deal? Do they have liquidity? Do they have a track record of acquiring companies? Figuring out who are the likely and best buyers. Marketing the offering, obviously M&A. If you're on the sell side of M&A, it's a big marketing role. Okay, very time intensive process. Coaching management in terms of what can and cannot be said once buyers start coming to the table and we start presenting to buyers. Once we get under contract with the buyer, facilitating something that we call due diligence. We'll talk about that a little bit more. And then finally, negotiating, hammering out a price, getting a contract in place, and closing the deal. Right, so again, we're going to talk about all of these different things in the slides ahead. When we talk about sales strategies, we can think of this in terms of the slide says 4 different types of strategies. Really, it's 4 different, levels of how broadly we market a transaction. All right, everything from an auction process where we're marketing a transaction very broadly, trying to attract the absolute maximum number of potential buyers, all the way down to a closed negotiation where maybe we're only engaging with one potential buyer. We're going to talk about all these in a second. Like I said a moment ago, this is usually the most broad marketing effort that we might engage in, going out to anyone and everyone that might have a potential interest in this company. Competitors, maybe suppliers to the particular industry, maybe companies in related industries, financial buyers, private equity firms, right? Going out and quote unquote boiling the ocean. All right? We don't want to miss a buyer here is kind of the goal. And through that, we want to attract maximum potential value, maximize the amount of competition for what we're trying to sell in order to accomplish that. And that, if we can do that well, there are obviously some advantages to that. Hopefully it means maximum price. Hopefully we don't miss a buyer, and because of that we stimulate the most amount of competition. The real big disadvantage here is on timing. This can be a very, very tedious, time-consuming process. Obviously, if we're reaching out to a large number of potential buyers, there's a lot of contacts that need to be made. There's a lot of materials that need to be sent out. There's a lot of follow-up that needs to take place. There's going to be a lot of folks asking a lot of different questions, and all of those things take time. All right, and obviously, if we get involved in an auction process, and between start and finish of that process, a lot of things can change. All right? We could have September 2008, where Lehman fails and the market craters, valuations plunge 40 or 50%, could kill the deal. All right, so obviously that's a major disadvantage. Obviously also confidentiality is an issue. If we take this out to the world, everybody's going to know about it, including employees, including competitors, including our partners, vendors. Everyone we deal with is going to know about it. We would need to be able to, we would have to be prepared for that and be prepared to manage that situation. We also get greater risk of what we call phishing, and that's basically competitors, different parties trying to get involved in the process, not because they're interested in buying, really more because they're interested in learning what are our secrets. What's the secret sauce? What's the secret formula of Coke? Those types of things. And if we're not successful, that is, if we go out to the marketplace and we don't get a deal closed and we have to go back out, there's no one else new to go back out to. So when people start seeing a deal 2 and 3 times, they obviously start to wonder, well, why didn't someone else buy it earlier? Right? And that can only have really that can only impact valuation in one way. Right? Over shop deals, valuations tend to fall. Make sense? All right, so that's an auction process. We might also engage in something called a controlled sale. This is, again, now this is taking the offering out to a more limited universe, still marketing it pretty broadly. Okay, so if we go out in an auction process and say we approach 50 different buyers, controlled sale might be approaching 20 different potential buyers. Right, so it's still a pretty large universe that we're going out to, but probably trying to focus on more logical buyers than just doing a full blast or boiling the ocean, as we say. Okay, so we maintain a little bit of confidentiality, hopefully while still getting a good amount of competition, getting a good approximation of market value. We still run the same issues, a lot of the same problems we talked about before. Competitors getting access to this, there's a confidentiality issue. Timing, it's still not a fast process. Right, this is still probably going to take some time to get done, and there's still that issue, that risk of phishing, as we talked about before. The targeted high-level solicitation, again, we're casting here a narrower net, approaching only logical buyers. Maybe we've done some qualification in advance to figure out that of that 50, or maybe of that 20 that we talked about in a controlled sale, maybe only 10 really have the capacity to close a deal. All right, so maybe we'd only approach them or limit it based on some other factor. Typically, contacts are going to be made a lot more directly. We're not going to just broadcast out a lot of marketing materials. We're going to really try and limit the extent to which this gets out in the marketplace. Ideally, what we're accomplishing here is speed, right? Getting a deal done quickly. As we'll talk about later and as we'll talk about a little tomorrow, a lot of times speed and certainty really outweigh valuation. All right? And I think we can probably all think of instances in which that's the case. All right, but getting out to the marketplace, getting a deal done quickly, maintaining confidentiality. All right. Obviously, if we're taking it out to a limited market, if we're not successful, there are still a lot of other buyers we can go out to. Okay, so we can avoid some of that risk of being perceived as a shopped or an overshopped deal, and hopefully still create some competition. Okay, the only real disadvantage here is just not risking or not reaching the full range of buyers. Maybe we're missing someone. And then finally, we've got what we call a closed negotiation. This is the most limited type of disclosure. We're really only going out to maybe 1, 2, 3 parties, maybe just folks that have expressed an interest in the past at buying the company. Again, here the main goal is to get a deal done, get it done quickly, and move on. All right, so here we may not, like I said, sometimes there's a trade-off between speed and certainty and valuation. So here we may not be maximizing value, but ideally we're accomplishing our goal of getting a deal done quickly. All right, I think the rest of that's pretty clear. All right, so valuation. All right, well, all the traditional methods that we've talked about here in class are what we use in banking. Comps, precedent transactions, DCF. Obviously, if we're talking about an M&A scenario, we're talking about the sale of a controlling interest. We're probably going to focus, at least to the extent that we can, on precedent transactions. It's probably the first place we're going to look, but we're going to look at all different types of analyses here. And this can take many, many weeks. All right, so after we get hired, going into a pitch, we might have an idea of valuation, but after we get hired, we're probably going to spend a lot of time. We're probably going to descend on company headquarters or gather in a room somewhere and basically get full access to all the books and records of the company, access to the management team, access to the CFO, really fine-tune that valuation expectation that we had early on in the pitch process. All right. Get to look at a lot of things like customer lists, sales pipelines, product roadmaps, product development materials, that type of thing, to really understand those projections and really fine-tune that idea of valuation so we can go out and sell that to the marketplace with confidence. All right, and one thing I'll note here is when we're talking, and we'll touch on this a lot more tomorrow when we actually talk about pitching, but when we're talking to the client in the early stages, when we're pitching and trying to win the business, it's usually important to give a reasonable picture of valuation at that stage, because eventually it's something we're going to have to perform on. In other words, if we go in and we tell the company we think we can get, $5 billion in a sale, but later we come back and we have to say, it's really only about $3 billion. That's going to create obviously a political problem with the client. It's going to need to be managed later on. So it's important to be reasonable, realistic, somewhat realistic in the pitch process up front when we're selling the client on what we can get them. All right, good bankers find value beyond the standalone business. All right, looking at different companies, different buyers, trying to uncover buyer-specific synergies, or maybe it's a better cultural fit at one buyer versus another, better strategic fit, the opportunity to exploit revenue synergies, cost synergies. That brand value might be worth more, or that brand equity and customer base might be worth more to one buyer than to another. All right, so this is really where the bankers need to dig in, really bring things to the forefront, and identify different areas where potential buyers can achieve maximum value. We talk about recasting. We're talking about a lot of the different things that we've done. Obviously, normalizing the financial statements is one thing that we always do. Strip out non-recurring costs, strip out non-recurring income as well. All right, but really making it very clear to the buyer what this asset might look like, what valuation should be, putting it right in front of them is really important here, and identifying kind of the true operating performance of the company. And this is where we're starting to wear our sales hat a little bit. M&A is a marketing role. We're out there trying to maximize value, so we're trying to position this as well as we can with potential buyers and still be justified in our presentation and our marketing efforts. All right, presentation and packaging. Okay, when we take this offering out to market, we obviously have to have a deal book. We've got to have some information that we present to buyers. And this is where the sell-side bankers spend a lot of their time, a lot of their effort is pulling together these marketing materials, putting them together, and not in a way that reads like a 10K, really something that reads more like a sales brochure. Putting together things like executive summaries or teasers, CIMs, confidential information memoranda, helping coordinate management presentation materials, other materials depending on the situation. These are usually very professionally put together, very well done, very slick. And again, books can be very, very thick, very detailed, can take up a lot of a banker's time. We're going to talk about each of these different items in a moment. Right, so when we talk about different buyers, again, we talked a little bit about this earlier. We're going to work very, very early on with management to try and identify and qualify a range of different buyers that we might approach here. And all of this, the selection is based on all of these